Welcome back to Prime Wealth. We're so glad you're here with us today.
Absolutely. Thanks for tuning in. We've got a really interesting topic lined up for you.
Yeah, today we're diving into something that a lot of folks wonder about, dollar cost averaging, and why it can actually beat trying to time the market.
Right. So many people think they need to, like hit the market at just the right moment to really cash in.
Exactly. And it can be super tempting, but we'll break down why that might not be the best strategy for most of us.
Yeah, we'll talk about how dollar cost averaging can help you invest consistently, even when the market feels unpredictable.
And we'll share some practical tips on how to get started and make it work for you, no matter your financial situation.
Plus, we'll touch on common misconceptions and maybe even share a few success stories.
Sounds great! So if you're ready to learn how to invest more confidently and avoid those market pitfalls, let's jump right in.
Let's do it.
So Alex, today we're diving into something that's really important for our listeners, especially those of us over 40, and that's dollar cost averaging.
Yeah, absolutely, Jordan. For many people, when they think about investing, they often get caught up in trying to time the market, right?
Right. Like, they want to buy low and sell high, but it's not that simple, is it?
Not at all. And honestly, trying to time the market can be pretty stressful, especially for folks who are nearing retirement or already in retirement.
Yeah, I mean, it's a different game when you're over 40. You're thinking about your future, your kids, college funds, maybe even your own retirement.
Exactly. And let's not forget about life events that can hit out of nowhere, like health issues or unexpected expenses.
Right. So with all that pressure, why do you think dollar cost averaging is a better approach?
Well, dollar cost averaging is a strategy where you invest a fixed amount of money regularly, regardless of the market conditions. It takes the emotion out of investing,
That's key. I think a lot of people, especially those of us over 40, can be prone to emotional decision making.
For sure. And here's a statistic that might resonate. According to a recent survey, over 60% of people between 40 and 60 worry about running out of money in retirement. That's a huge concern.
Wow, that's really eye-opening. So how does dollar cost averaging help with that?
Well, it helps by reducing the risk of investing a large sum at the wrong time. Like right before a market downturn.
So it's like, instead of trying to guess the best moment, you're spreading your investment out over time?
Exactly. Let's say you invest $500 every month. Some months the market might be up, and some months it might be down. But over time, you're averaging out those highs and lows.
That makes a lot of sense. And it's less stressful.
Yeah, and for people over 40, it can be especially comforting. We've got a lot going on, family, jobs.
Right. And I think about how many people feel they've missed the boat on investing.
Absolutely. But with dollar cost averaging, it's never too late to start. You're not putting all your eggs in one basket, so to speak.
So let's say someone decides to start this strategy now. What does that look like in real life?
Great question. Imagine someone in their early 50s decides to invest in an index fund. They set up an automatic investment of, say, $300 a month.
Okay, I can picture that. They're not stressing about the market's ups and downs, right?
Exactly. Over time, they accumulate shares at various prices. When the market dips, they buy more shares for the same amount of money.
So they're potentially getting a better deal?
Right. And here's the kicker. Historically, the market tends to go up over the long term. So even if they face some downturns, they're likely to benefit from the market recovery eventually.
That's really encouraging. I think about how many people I know who, just avoid investing because they're scared of losing money.
That's such a common feeling, especially for those who've seen market downturns. But dollar cost averaging can help mitigate that fear.
Right. It's like, hey, you're not alone in this.
Exactly. And here's another thing to consider. Many people over 40 are also thinking about their legacy. They want to leave something behind for their kids or grandkids.
Yes, that's so important. So dollar cost averaging not only helps us build our own wealth, but it can also create a foundation for future generations.
Absolutely. And it's a strategy that can be adjusted as life changes. If someone gets a raise, they can increase their monthly investment.
Or if there's a major life change, like a job loss, they can scale back without feeling like they've completely derailed their plans.
Exactly. It's flexible, which is crucial at this stage of life.
And let's not forget the emotional aspect. Many folks over 40 experience a lot of anxiety around finances.
Totally. Dollar cost averaging can provide a sense of control. It's a way to invest without needing to constantly watch the market.
Yeah, and that's a huge relief. I think about how many people are glued to their screens, checking stock prices and feeling that roller coaster ride of emotions.
Right? And that can lead to poor decisions. With dollar cost averaging, you're committed to your strategy, which can help keep your emotions in check.
So if you're investing consistently, you're less likely to react impulsively, right?
Exactly. And, over time, it can build a habit of investing.
That's a great point. It's not just about the money. It's about creating a mindset, too.
Yes! And for those of us over 40, building that mindset can be incredibly beneficial, especially as we approach retirement.
So to wrap it up, dollar cost averaging really provides a solid strategy for anyone worried about market timing, especially for those of us in this life stage.
Absolutely. It's about taking a long-term view and feeling empowered in your investment journey.
And that's such an important message. I think it's time to transition into some core strategies for getting started with dollar cost averaging. So Alex, today we're diving into this concept called dollar cost averaging.
Right, yeah, it's a really powerful strategy, especially for folks over 40 who are looking to invest for retirement or other long-term goals.
Exactly. So can you break it down for us? What exactly is dollar cost averaging?
Sure. Basically, it means investing a fixed amount of money at regular intervals, regardless of the market's ups and downs. So, instead of trying to time the market, you just consistently invest.
Oh, I see. So let's say you decide to invest, $500 every month. Yeah.
Exactly. And whether the market is at a high or a low, you just keep putting in that same $500.
Right. So it's like you're not as worried about whether you're buying at the right time.
Yep. And that's really one of the key benefits. It takes the emotion out of investing. People tend to panic when the market drops or get overly excited when it's up.
Yeah, I totally get that. So how does this actually help?
Well, over time, dollar cost averaging can lower your average cost per share. Let's say the price of a stock fluctuates. If you buy more shares when the price is low and fewer shares when it's high, you end up with a better average price.
Oh, that makes sense. So, if you invest every month, when the market dips, you're getting more shares for your money.
Exactly. And then when the market rises, you have more shares that could potentially appreciate in value.
So it's almost like you're buying on sale when the market dips, huh?
Yes, that's a great way to put it. And it helps you stay consistent, which is key to building wealth over time.
Okay, but say someone is just starting out. How do they get into this?
Good question. First, you want to set a budget. Figure out how much you can comfortably invest each month without stretching your finances too thin.
Right, and then what?
Then, choose an investment account. It could be through a brokerage, a retirement account like an IRA, or even a 401k if your employer offers one.
Ah, I see. So, once you've got your account, you just set up those regular investments.
Exactly. Most platforms allow you to automate your contributions, which makes it super easy. You just set it and forget it,
Love that. So I can just set it to pull money from my checking account every month?
Yep. And that way, you're consistently investing without having to think about it.
And how do you choose what to invest in?
Great point. It's important to do your research. You can consider index funds or ETFs if you're looking for diversification. They give you exposure to a wide range of stocks without having to pick individual ones.
So that's a way to spread out the risk.
Exactly. By investing in a variety of stocks, you're less exposed to the swings of a single company.
Okay, so let's say I've been dollar cost averaging for a while now. How do I know if it's working?
Well, you'll want to regularly review your portfolio and see how it's performing. But remember, investing is a long game, so don't get too caught up in short-term fluctuations.
So you're saying I shouldn't panic if I see a dip in my portfolio value?
Right. Those dips are part of the market cycle. If you've been consistent with your contributions, you're likely still building wealth over time.
That's comforting to hear. So any simple rules of thumb for someone starting out with this?
Definitely. One rule of thumb is to invest what you can afford to lose, especially in the beginning. This helps you manage your risk.
And what about how much to invest?
A common suggestion is to aim for 10% to 15% of your income. But honestly, start with whatever amount feels comfortable for you.
So it's really about finding that balance.
Exactly. And even small amounts can add up over time thanks to compounding interest.
Oh, I love that. It's like planting a seed and watching it grow.
Yes, and speaking of growing, you might want to revisit your investment strategy every few years. As you get closer to retirement, you might want to adjust your risk level.
That's a smart idea. So keep it dynamic, right?
Exactly. The market changes, and so do your personal circumstances.
Okay, so we've covered a lot about dollar cost averaging and the benefits, but are there any common pitfalls people should watch out for?
Absolutely. One big pitfall is the temptation to stop investing during market downturns.
I can see how that would be a mistake.
Right. It's crucial to stick to your plan even when the market is shaky. Remember, dollar cost averaging is about consistency.
So if you stop, you miss out on those lower prices.
Exactly. And another pitfall is letting emotions dictate your investment decisions.
Like panicking when the market drops, right?
Yes. Or getting overly excited about a market surge. Stick to your dollar cost averaging strategy and keep your emotions in check.
This has been super helpful, Alex. So to wrap up, dollar cost averaging is all about consistency, automation, and most importantly, keeping a long-term perspective, right?
You got it. It's a solid strategy for anyone looking to invest without the stress of timing the market.
Awesome. Thanks, Alex. I can't wait to share this with our listeners. So, Alex, we've talked a lot about dollar cost averaging and how it can really smooth out those market ups and downs. But let's dive into some common pitfalls people fall into when they're trying to invest.
Absolutely, Jordan. It's really important to understand that even good strategies can go awry if we're not careful.
Right? Like, one mistake I see often is people trying to time the market instead of sticking to their plan.
Exactly. You know, the idea of trying to buy low and sell high sounds great in theory, but in practice, it can lead to some serious headaches.
Yeah, like, I remember this one guy, let's call him Tom. He was really convinced that he could predict when the market would drop, so he held off on investing for months.
Oh no, that's a classic example. Did he end up missing out on gains while waiting?
Totally. By the time he finally decided to jump in, the market had already surged. He lost out on a lot of potential growth just because he was waiting for the perfect moment.
That's such a common story, and it really shows how emotions can play a role in investing. You know, fear and greed can lead us to make decisions that don't align with our long-term goals.
Yes! And speaking of emotions, another pitfall is letting short-term market fluctuations dictate your investment strategy.
Right? Like when the market dips, some people panic and sell off their investments, thinking they're avoiding losses.
Exactly. I had a friend, Sarah, who did just that. She saw a downturn and sold her stocks thinking she'd save her money.
Oh, that's tough. Did she realize later that she sold at a loss?
Yes. By the time she came back to the market, it had recovered, and she missed out on those gains. It's like she locked in her losses instead of riding it out.
That's a great example of how important it is to stick to your strategy. Dollar cost averaging helps with that because you're consistently investing, no matter what the market is doing.
Right. It's like you're taking emotion out of the equation, which is huge.
Yes! And another mistake I often see is people not being diversified enough. They might, put all their money into one stock or sector, thinking they'll hit it big.
Oh, gosh. That's risky. I've heard stories where someone put everything into a tech stock.
Exactly. And then when that sector takes a hit, so does their entire portfolio.
It's like betting it all on red at a roulette table, right?
Haha. Yeah, pretty much. And the thing is, diversification isn't just about different stocks. It's also about different asset classes. Bonds, real estate, maybe even commodities.
Right, so mixing it up can help protect against those downturns.
Absolutely. And a warning sign is when you find yourself overly confident about a single investment.
Yeah, that's when you might want to take a step back and reassess.
For sure. Another common mistake is ignoring fees. Some folks don't realize how much fees can eat into their returns over time.
Oh, that's so true. I mean, even a small percentage can add up, especially over decades.
Exactly. I had a client once who was paying, 1.5% in fees on her investments. We switched her to a low-cost index fund, and she saved thousands of dollars over time.
Wow, that's a big difference. So what should people look for in terms of fees?
Well, you want to check the expense ratios of any funds you're considering, and also be wary of any hidden fees that might not be immediately obvious.
Yeah, transparency is key. And I think people also get caught up in wanting to chase the latest trends or hot stocks, don't you think?
Absolutely. Chasing after what's hot can lead to poor decisions. Sometimes it's just better to stick to what you know and what fits your goals.
Right? Like a solid long-term strategy is more reliable than trying to jump on every bandwagon.
Exactly. And if you're tempted to chase trends, a good sign to look for is whether you've done your research or if you're just following the crowd.
Yes. If you can't explain why you're investing in something, it might be a red flag.
And then there's the issue of not having a clear plan or goals. Without knowing what you're investing for, it's easy to get sidetracked.
Right. I've met people who just throw money at investments without a defined purpose, which can lead to confusion later on.
Yes, having a financial plan helps keep you focused and makes it easier to stick to your dollar cost averaging strategy.
So, what would you suggest for someone who's recognized they've made some of these mistakes?
Well, first of all, don't beat yourself up. Recognizing the mistakes is the first step. Then, take a deep breath and reevaluate your strategy.
Yeah, like maybe it's time to diversify a bit more, or look into those fees you mentioned.
Exactly. And consider setting up automatic contributions to your investments. That way, you're consistently putting money in without having to think about it.
Great advice. So it really comes down to being mindful and intentional with your investing.
Absolutely. And remember, the market will always have ups and downs, but sticking to a solid plan can really help you weather those storms.
So true. Thanks for sharing these insights, Alex. I think it's really empowering for our listeners to know they can turn things around.
Of course, Jordan. It's never too late to start fresh and make those adjustments for a better financial future.
All right, let's transition into some next steps for our listeners. So, Alex, we've talked about dollar cost averaging and why it's such a great strategy. But what can our listeners do right now, today, to start applying it in their own lives?
Yeah, that's a great question, Jordan. I mean, the first thing I'd suggest is to, take a look at your current investment accounts and see if you can set up automatic contributions.
Oh, absolutely. I think a lot of people don't realize how simple that can be. Just, set it and forget it, right?
Exactly. Most brokerage platforms allow you to set up automatic transfers, so you can decide on a set amount to invest, say monthly or even biweekly. It's a way to make investing a habit, which is key.
And if someone's just starting out, they might be wondering, how much should they start with? Is there a minimum?
Well, it really depends on the platform, but many allow you to start with as little as $10 or $20 a month. It's more about the consistency than the amount at first.
Right. So even small amounts can add up over time, and it's all about building that habit.
Exactly. And, I'd recommend using apps that focus on this kind of investing. There are several out there like Acorns or Betterment, which are great for beginners.
Oh, I've heard of Acorns. They round up your purchases and invest the change, right? That's such a clever way to get started.
Yep. It's a really easy way to incorporate investing into your daily life without feeling the pinch.
And what about tools for managing your investments? Anything specific you'd suggest?
Sure. A lot of people find tools like Personal Capital or Mint helpful. They can help track your net worth and spending habits, which is good to know as you start investing.
Yeah, understanding your finances as a whole is so important. It gives you a clearer picture of what you can afford to invest.
Exactly. And another tool I'd recommend is setting up a budget if you haven't already. Just understand where your money is going each month.
Right. Budgeting can feel a bit daunting, but once you have it in place, it really empowers you to make informed decisions.
Yeah, and you can use apps like YNAB or Every Dollar for that, which can make the whole process a bit easier and more intuitive.
So to sum it up, setting up automatic contributions and using budgeting tools can really help, right?
Absolutely. And don't forget about education. There are some great books out there that dive into these topics. I'd recommend The Intelligent Investor by Benjamin Graham or A Random Walk Down Wall Street by Burton Malkiel.
Oh, I love that. Those are classics. It's so important to, keep learning as you go along.
For sure. And if you're more of a podcast or video person, there are tons of great resources online. Just find what resonates with you.
Yeah, I think finding your preferred learning style makes it feel less like a chore and more enjoyable.
Exactly. And, one of the biggest things to remember is to be patient. Investing is a long game. Building wealth takes time, and that's okay.
So true. It's all about consistency and sticking to your plan, even when the market gets a little crazy.
Right. And if you find yourself feeling nervous, take a deep breath. Revisit your plan, remind yourself of your goals, and trust the process.
And I think it's also helpful to connect with the community, whether that's through online forums or local meetups. Sharing experiences can really boost your confidence.
Absolutely. Engaging with others who are on the same journey can provide support and encouragement, and you can learn from one another.
So let's recap some immediate actions our listeners can take. Set up those automatic contributions, use budgeting tools, read a good book, and connect with the community.
Yes, and remember to start small. It's about building those habits over time.
Exactly. Investing doesn't have to feel overwhelming. Just take it one step at a time.
And if you ever feel stuck or need guidance, don't hesitate to reach out to a financial advisor. We're here to help you navigate your journey.
Well, I think that's a perfect note to end on, Alex. So much valuable advice today.
Thanks, Jordan. I really hope our listeners feel empowered to take those next steps.
I'm sure they do. All right, everyone, thanks for joining us today on Prime Wealth. If you enjoyed this episode, don't forget to subscribe and share it with someone who might benefit from it.
Yes, and keep investing in your financial future, one step at a time.
Until next time, take care, everyone.
Well, Jordan, it's been a great discussion today on dollar cost averaging.
Absolutely, Alex. I mean, it really sheds light on how, investing can be more about consistency than trying to hit a home run.
Right. So just to recap, one key takeaway is that dollar cost averaging helps reduce the risk of market volatility by spreading out those investments over time.
Yeah, and it takes the pressure off trying to time the market perfectly, which, let's be honest, is tough for anyone, right?
Exactly. And another point we touched on was how it encourages discipline in your investment strategy. You're investing regularly, no matter what's happening in the market.
Right. Plus, it makes investing feel less intimidating for folks over 40. I mean, it's like a steady approach to building wealth.
And let's not forget about the compounding effect. Over time, those small, consistent investments can really add up, huh?
For sure. It's like planting a tree today to enjoy the shade tomorrow.
Well said. So, for everyone listening, remember that patience and persistence are key. It's not about getting rich quick, but about building a solid foundation for your future.
Yeah, and if you found this episode helpful, don't forget to like, subscribe, and share it with someone who's 40 or over. We'd love to hear your thoughts in the comments.
Absolutely. We're here to support each other on this financial journey.
And next time, we'll dive into blue chip stocks. Those companies that seem to stand the test of time.
That's right. So you won't want to miss that discussion.
Thanks for joining us today, everyone.
Take care and happy investing.
Bye for now.